There you go. I think I finally managed to make it work. Not the best morning ever. Started out with a little bit of technical issues. Uh, Throughout the weekend, I cleaned up the PC. I updated a few drivers here and there, and looks like I messed up something in the process. And well, basically, OBS just just forgotten all my settings, and it was recording like shit. So at the moment it wasn't picking up the video, and you fix that, and in the other moment it wasn't picking up the audio, and it was all messed up. But after the 20 minutes of troubleshooting, I managed to get back to, I guess, acceptable settings. We'll see. Sure, it would be frustrating if I record a video now and then it is all just bullshit. But yeah, let's gamble here. So weekly market recap once again. Sunday morning, um, started to be a bit late due to all the issues, but let's try to put them in the past. Now, bit of an interesting week this week. There were a few things that I think I got good enough, and a few things that I completely missed. Right, but such is the nature of markets. You can't be right every single time, and as a matter of fact, there are going to be many times where you're wrong. Of course, minimal stuff. It's not that I'm actively trading all the markets, so it was just for the sake of trying to make an analysis and then a potential forecast for the week to come. And a few things weren't particularly in line with expectations, others just didn't. And I'll make sure to highlight what was kind of in line and what was not. But as usual, let's start out with the economic calendar for this week. It was a busy week, as you can see from the data points. Um, One which caught my attention was Canada dropping rates once again, and it looks like at this point they are really going down this rates cutting cycle, right? They started out in April, and basically they dropped from basically 5 to 4.25 now. But it looks the path ahead. It's still on the downside for Bank of Canada. I would expect the others to follow now that even the Fed is finally giving the green light, or well, Powell already gave that out, was confirmed on August Jackson Hole, but the signs, the evidences were already there, well ahead. Now we also got jobs openings, which still confirming the downtrend. So the labor market cooling off. Although, as we are about to see, the unemployment rate ticked down just 10 basis points, just a little bit. I guess, there was a little bit of a seasonality into that when it got to 4.3, and also the weather. As funny as it might sound, but the weather can actually impact these month-over-month reports. Uh, there was, I guess, some sort of a hurricane season in the US, especially. I was reading one of the region which was hit the most was the South, particularly Texas, and I guess it was the Hurricane B- Beryl, something like it. So of course, if you got something like it going on, you expect people to be uh, laid off instead of being hired because nobody's working. If there is a storming which is hitting the region where you are supposed to conduct your business and presumably to be working as an employee, right? So it might be a little bit of that when it comes down to unemployment rates. Um, as for the rest, we got PMI, nothing particularly relevant, at least to my eyes there. But I guess the major point of the week was the NFP report. As usual, it's very high impact news, NFP non-farm payrolls. But as we are about to see when we dig a little bit more into equities and the indices, I guess it wasn't really the data, the headline, which shocked the markets. It was more for probably the revisions, because if the headline was, of course, a little bit of a miss, right? 20k miss as for the jobs, but if you look at the previous one, you might say, yeah, well, previous one was particularly low, around 19, 90. So ending up with 142k, it's not bad. Well, it wouldn't be bad if you discard completely the downtrend we are looking at, and especially if you discard all these revisions, the black lines on these, and I messed that up. Right. The black lines on this chart right here, those are revisions. And you can see that more often than not, these numbers have been revised lower, especially recently. And so when the market looks at what's going on, sure, the headline, it is usually what the market cares about. But if it starts to be a consistent pattern where you also have every single time downward revisions for previous data points, at a point, I guess the market would pick up with it. So the initial reaction, as we are about to see in the charts, was, the figure is still good. It's a little bit of a miss compared to the expectations and the forecast, but still good. So the market initially spiked up, but then it just collapsed. Probably, maybe, I'm saying just maybe, it was because after reading the headline, people started to dig into the actual report and they saw the revisions and they said, well, you know what? If you add it on top of what we have seen starting, basically from last June with that CPI report, which was particularly disinflationary, maybe this is going to add to the narrative, which is now shifted, and now bad news are really bad news. So it could be a little bit of that, maybe, right? But let's look at the charts. Now, again, we start out with FX, the currencies, the usual suspects here. Um, we had a little bit of a bounce in the DXY starting out the week, and then it ended up on the lows, basically same macro range we are always looking at. We've seen again the euro and the pound, they drew back a little bit, but they ended up the week with a little bit of a rally, and then of course, on Friday they just declined a little bit. So I guess the star of the show when it comes down to currency, it's still the yen, the JPY against the US dollar, which again had a little bit of a pullback, then it got a little bit stable, and now it's just ticking up again. So JPY strengthening against the US dollar, which I didn't really put a lot of thoughts into it, right? When it comes down to this yen carry trade. But I was just thinking, a little bit, and I know it's just an academic debate, maybe, or maybe it's just me that I need to find some better ways to waste my time. But I was thinking, you know what? Could we apply the principle, the problem of the chicken or the egg here? Like, is it the yen carry trade unwinding which brought markets down, or, you know, markets started to come down, and so, people starting to get out of those positions, naturally getting out of those, they also have to close the other leg, the financing part, which was allowing them to open up those positions on a massive leverage. So could it be, or at least we could start to look at that like maybe the initial spike was a little bit about the leveraging event, yeah, but now the continuation could be explained, so to speak, like the initial spike was just the leveraging, people were caught off guard and they needed to readjust to cover, you name it. But now, if you see this phenomenon going ahead and keep on enduring, it might be that people are just exiting the carry because it's not like you don't have the incentive from from an arbitrage standpoint anymore, but maybe you don't have the incentive because now you see that the real economy conditions and therefore sooner or later the stock market will pick up to them, and now you see, you know what, I'm just going to the risk, so I'm not incentivized anymore in putting on these arbitrages and to take advantage of the carry because I'm not interested on putting on those positions in leverage and founding them uh, in the by borrowing yens and then deploying that capital in the US stock market. So it was just a thought, could be totally not correlated. We do know that correlation is not causation, but I was just thinking about it. So who knows? It's just one other of those things that you keep on monitoring and you look at what it's going to unfold from that. Eventually, whether this is happening for one reason or the other, if you are a trader, price action is all you need. But sometimes, it's just funny and amusing to start to formulate hypotheses and try to come up with different ideas, right? Just for the sake of it. So again, maybe I should really waste my time in a much better way. But anyway, let's have a look at gold, which was one of the markets that compared to last week forecast, I kind of got, let's say, quote unquote, right. Uh, we've seen, we were talking about a little bit of a weakness and how the market, gold in this case, was losing a little bit of steam to the upside. And what we got, it's really nothing particularly crucial right here, right? Didn't go up for new highs, but at the same time, it didn't go down for new lows. So just sideways, a little bit of a consolidation. Now, again, could this be reaccumulation before shooting higher again, or could this be just a distribution pattern and the market putting in a top right here around the top and then a little bit of a correction? I'm particularly neutral at the current moment in time. As I said, all I do care about for gold right now is trying to establish points of failure. So as soon as the market is like this, I'm not particularly in a hurry to move around any positions. But if it starts to break some lows and it starts to manifest lower highs and lower lows, then at that point you might want to de-risk a little bit. We were looking at maybe it was on Bitcoin, maybe the divergence, the cumulative delta when it comes down to volumes. It's not like gold; it's particularly bullish if you just look at these, but still, it's not that bad compared to other things. Speaking of Bitcoin, we've seen, and just for the sake of it, just bringing in the same indicator, right? That is the logic of it, right? The price, it's consolidating, but the delta, it's just declining. And so, you expect a little bit of a weakness. Now, again, as I said last week, I do use these sort of tool intraday. I never really back tested it on a higher time frame. The logic and should be the same, right? But still, it's just an observation. I wouldn't put really a lot of emphasis into it because I never really digged a lot into it, nor back tested it for real. It's just simple deductive type of a reasoning. Okay, so nothing more than that, but still, it it worked a little bit even on this time frame right here, which is daily, and it's spread out on, at this point, a multi-month period. So it was the beginning of March when we started this consolidation. So it could be. Um, Bitcoin took another dive to the downside. As I said, I wouldn't be a buyer at this level. We got another reaction, but eventually the bounce was faded. And I think at this point, right, we are probably, I'd say, going to revisit the lows. Now, This one right here, this spike around 50, mid 52K. Could this be already the revisiting of the lows, and then from here it just put itself together for a little bit of an upside? Mm, I wouldn't be so confident, but up until the point we start to reclaim a few levels, right? It is just that every time it comes back up to retest a relevant level, to maybe shift the flows, to maybe shift the structure, it is severely punished and rejected. So this is why I'm not particularly bullish on Bitcoin at this current moment in time. Now, of course, the more it can stay in this range, the more you can keep up the bullish opium that this is just reaccumulation. But in order to, you know, having a victory lap on that type of assumption, you would need the market to start to shift around a little bit to the upside. And again, up until this point, I never seen something like it. So I keep on being slightly bearish on Bitcoin. And again, especially when I think about it in correlation with other risk-on assets, because we're gonna get to equities in a minute. But you know, if you want, I guess, a little bit of opium as for Bitcoin, you might want to check this one out, which pretty much everywhere you look now, everyone is talking about the Bitcoin production cost. It was, I guess, 2 3 weeks ago maybe that even a good friend of mine actually made a video on it. So kudos to Anthony. He brought up a very sound and good logic uh, about the reasons why you should start to look at Bitcoin as a commodity, and commodities, they do tend to mean revert, right? To gravitate around their production cost. So standing to this chart, it looks like as for now that should be around 43K, or maybe I'm reading it wrong. What's that? This is the electrical cost. That is price. The production cost should be around 60K. Really? Hmm. So I guess I would need to read to read a bit more into it. But just by looking at the chart, this is basically assuming that Bitcoin throughout his history from 2015 to recent days, it always bottomed out around the lower band of this channel, which again should be, well, the electrical cost. That's what the chart is saying. So if you want a little bit of opium, you might say the next bottom for Bitcoin should be around 43, which if we look at the chart, 43, or let's assume it just spikes a little bit further down than that due you know eventual liquidation momentum, lack of liquidity, whatever you want to pick, that would bring Bitcoin right around this level right here, which is not a bad level, all things considered, at least for a nice bounce. Then, of course, the game starts to be whether this bounce gets faded once again or not. Um, of course, standing to this chart, you have no reasons to believe that this is not going to be the bottom, right? It is just a statistical truth at a point. And you can't just deny statistics. So this is a relevant piece of information, and something that you should consider. Uh, I think maybe trying to catch the knife wouldn't be a wise idea, but it is also true that everything comes down to your time horizon and to your plan. So let's say if this production cost analysis has been proven right all this time, you might say, you know what, even if then price spikes even farther down of another 10, 15%, if I have a very long-term type of a view on this asset, and I think overall in the coming years is going to be much higher as for price, I'm willing to buy at those levels because I think at those levels that is a fair price, or again, even a cheap price historically. So no leverage, just spot holdings, and that could work for me. It's a plan like any other. Why not? I mean, it could be an idea, right? So although in the very short term, I'm still particularly bearish oriented on this one. The narrative of this production cost needs to be taken into account. Now, again, it's like every other piece of edge. There will be a point, maybe, that where it will be proven to be wrong. Maybe just in the short term, like 43 is the magic number as for now, and the chart is going to be updated, of course, because it can change and vary around. But it's 43, it's the magic number for now. Price might spike down a bit more than that. Yeah, it could be, but it's not a line in the sand. It's just a level, a region where price would tend to gravitate around. It's like the moving averages, the means, all that shit. If it is an average, of course, price will have to live above and below it. Like in this case, if it is a cost of production, you might have periods where the price of the commodity could be below the cost of production. But technically you could, but that would incentivize people to get into the market and actually bidding that up because it's a nice buying opportunity. So again, just use that information as your own as your as you wish to your own discretion. I think it's relevant. For me personally, it's not enough to put on some actual risk, but again, maybe I have a different disposition, maybe I have different preferences, right? Let's move on. Let's have a look at oil, which this one I was completely wrong. Not in the sense that it didn't go down, but I said I would expect it to be a bit sluggish, a bit sloppy, and do not expect some sort of a sharp move. What do you get? It's actually a very sharp move. So basically, this one it just went down. So if you look at this, right, it's just straight down. No relevant pullbacks, no nothing. Um, I guess with a little bit, of course, of an hindsight benefit, but I might have been able to notice that this area was a little bit dry, right? So one, two, three, and these already failed at this point. And so, if you see a rejection here, look at this level right here. Where did it picked up into? This one. So, and this one already was some sort of an ascending type of a base pattern. So every time price was coming up, it was picking up liquidity below it. So you do expect at a point this area to be dry, right? So maybe I missed that when I was saying probably sloppy, not sharp. I guess that's the missing part. That all the liquidity around here was already depleted, which again works on an intraday base. Apparently, it works on a higher time frame type of a base. So again, uh, we're not perfect. We're all humans, just imperfect creatures. So it's normal that we make mistakes, right? Um, as for oil, let's look at the break-evens, but they're not really telling us anything new. It's always the same. They're downtrending, and they took another deep dive together with the price of oil. So nothing new here, right? And even if we look at the curves, the futures curve for oil, you see the October expiration closed at 68, and down the line for November, December, getting into 2025, we got lower prices. So the futures market is pricing oil lower even in the coming months, which again should represent disinflation, and I know it's some sort of a boogeyman type of word, but recession, right? At this point, I guess the recession fears came back up to their highs, and everyone it's now back on the train of recession. I I don't really know. Like I get the point, and I'm the first to agree that the data, the fundamentals are not good. But you know, again, the problem is always the same. When everyone is talking about the same thing, you usually get something else coming. And even in the case, you're gonna know you were into a recession like 1 year later, because the way officials actually declare recessions, it's always post dated. They come at you saying, "Oh, you know what? By the way, you remember 9 months ago, after all those revisions, yeah, back then we were into a recession, and yeah, just be aware that I'm telling you now, and by the time I'm telling you, we are probably on our way out of the recession. We might be already in the recovery phase. So, if you go by the book, by the official definition of a recession and the timing that they got actually providing you the information, you're always behind the curve. Same as they are, right? Officials, the Fed, the NBR, or whatever the name is, the entity which is responsible to actually declare recessions, they're always behind the curve. So I guess, although you might argue financial markets are manipulated, but price action is always a much better type of information. We have tried to ruin the the you know the information function that price has in these markets with all the possible interferences and interventions and distortions that the government all across the world has tried to bring into these markets. But I always say, at a point, you can't really fight the market. It's like trying to fight gravity. It can go ahead for just a period of time, and at a point, gravity always takes over. So again, that's how I see it. Let's move into equities right now, because even here, I was saying the chart is bullish. The fundamentals are not, but the chart it's still bullish. At least it was last Sunday when I was looking at it. And you do trade the market you can't trade the market you wish you had, because that's impossible. It's nonsensical, right? But it looks like the market had a little bit of of a dump right in here. Was a bad week for stocks in general. Now the Nasdaq is still the weakest of the two, or the weaker of the two, while the S&P it's holding up. You might say relatively better, but it I'm not gonna say it doesn't look good or it looks like it's fucked, but at least it looks a bit weak. Now, as for the S&P, I guess we could still try to save this one at and around the 100-day moving average. If that doesn't hold, I guess we are going to revisit the lows, which would be coincidentally around the 200-day moving average. The Nasdaq is already past there. We already closed below the 100-day moving average. Was on Wednesday. We tried to rally off of it and reclaiming it, but we opened and closed below, and then on Friday it just went down. So that would, even in the classical way, that would confirm a breakage of the moving average, right? So if you remember, we were looking at the different sectors, and I said in a real bull market, I would expect the Nasdaq to be leading the charge. Standing to past returns and how the cycle played out in the past, there are sectors which cyclically lead the way to the upside, lead the charge to the upside. And even if after the August dump we had this some sort of V-shaped recovery, it was mostly driven by the S&P. So again, the breadth of the market actually widened up, but the sectors which was supposedly responsible to leading the charge, they really weren't what you expect. So that's why I was a little bit skeptical. Although, at the same time, up until the point you had, because now you don't. But if you look at past week, right, up until the point you had a market which looks like this, just try to imagine these bearish candles are not here. Up until the point you got a market like these standing in here, it was just looking bullish. So of course, throughout the week, you need to readjust that expectation and saying, you know what, something is not something is not cool here. So if you remember that there is that tiny little line from the chart which is bullish, but the amount of risk that's out there. And I spent, I guess, the last month talking about the potential risks and why and what could lead into a little bit of a downturn. Could be short term, maybe, who knows? But just being cognizant of the risks is always the first rule of thumb, I guess. So this was the S&P up until last week, holding these reclaimed level. It went for a little bit of a last attempt, and then it just crashed. The problem I see with it's just it crashed below a level which you really shouldn't want to see. You might have a little bit of a correction here, yeah, but you would expect at least this level right here to be held. You might feel the gap, but then you expect the bounce. There you didn't. So at least even if you have a little bit of a much longer time horizon, I'd say at this point, if we were bullish, let's say, at least now you should switch to neutral. Again, I would be a little bit careful going full on bearish right now because stocks tend to be particularly hard to short as far as I can see. So, just bear it in mind. You might want to use, let's say we got a bounce or a relief rally or whatever you might want to use that to de-risk your positions, to manage your risk, to take advantage of the bounce, to trim down a few exposures you might have still on, just to reassess or to reduce the risk. But other than that, I don't see a rosy picture for stocks at the current moment in time. Then, of course, same as last week, another 5 trading days will go by, and I'll probably be sitting right here next week saying, the market did the unexpected once again. So, you always need to assess it in real time, day by day, session by session. It doesn't really make it justice being here once a week saying what happened the past week and based on that, what could happen at the end of next week. Uh, a lot of stuff could happen in 5 days, especially when you got a situation like the one we're living in right now, which is precarious to say the least, with all we see around, election risks, um, recession fears, the labor market softening and whatnot. So again, just bear in mind that things could shift around very, very quickly throughout the week. So you need to be, again, an abused term on my end, but you need to be nimble. Okay. Now, just for the sake of it, I was looking at it, right? And although on the V-shaped recovery, the breadth of the market actually expanded, widened, right? Uh, this expressed the percentage of stocks which are above the 50-day moving average, if I'm not mistaken. So you see that up until a point, everything looks cool. Of course, this is not updated. Basically, this is back to the close of last week when I was recording my video saying it looks bullish, right, based on this data. But the problem with it is that it just takes so much, and then you got something like this. Basically, you got a good amount of stocks which were hammered, and now people are starting to notice that, is it is it particularly bad? Is it particularly good? What was that about? Because it shifts around so much and so quickly that people myself included, are really sometimes struggling to keep up the pace, right? So beyond that, as for stocks, you might look at the seasonality, right? And of course, you see that September is not a good month. Now, as those good people say, past performances are not guarantee of proof of future performances, right? But again, it is a statistical reality that September it's not particularly cool. More often than not, a closed negative. The average return was not that big of a deal in the end, -7%, -0.7%. Um, but still, considering this is an average, if you look at the two extremes of the spectrum, it is true that some Septembers, the stock market returned 9%, but you also got someone which returned closer or at -12%. And that's your standard deviation of 4.4%. So again, just another type of statistics which should at least put you on your feet when we get throughout this period of the year, right? The last one will be this, because I was saying one of the main and key factors for keep on being bullish is the fact that corporate share buybacks are one of the main factors which bring in demand into the market for stocks. The point is, if you look at the pattern right here, is that we are entering in a period where these buybacks are probably weakening. Um, I guess starting from September the 5th, you already have the buyback window closing down for a few companies. And by the end of the month, everyone, every single one of them will be in a blackout buyback window because, of course, we are going to get in earnings season once again. So that's another reason why you could expect or you should be cognizant of the risk of a little bit of a buying pressure to be taken out of markets, in this case, equity markets. Plus, again, as is written in here, you can see all the other type of risks that the market might try to assess and to defend itself against at this current moment in time. So, oh yeah, it was September the 5th. Yeah. So again, just be a little bit defensive, I guess, if this is the price action we're gonna see being confirmed getting into next week, because we we are probably facing a bit more downside risk, okay? And especially after closes like these, right? Massive down day on a Friday. I think on Monday we might have a little bit of a continuation. Probably not as much as this candle, but a little bit of a continuation, and maybe we might work on a bounce. I don't know, Tuesday, Wednesday, and we'll see what's going to happen next. But at first glance, yeah, I would expect a little bit of a weak open on Monday for the indices. So there's that. Now I kept this time around bonds for the last position when it comes down to the schedule, because there are a few things I wanted to show about bonds. Now, when it comes down to price action, you've seen the bonds, they basically went up, so no surprises there. And conversely, if you look at the yields they just went down. And again, the short end of the curve came back down sharper, quicker, and faster than the long end. But at the same time, if you just look at the chart, the long end it's defending itself pretty well when it comes down to the upward move. Like, it's really going up. While when you look at the short end, yeah, it's going up, but it doesn't look like a sharp pump as you've seen here. Which brings us back to convexity, as I was saying, right? So again, just bear it in mind. I wanted to spend a bit more time on basically bonds, yields, maybe Fed funds and whatnot, because I was digging a little bit into it. I was trying to answer uh, questions like these, for example, right? I and again, this is not to prove other people wrong or to shit on other people ideas, right? It's just to put things a little bit in perspective, right? You don't go around calling people right or wrong. That's not what you want to do. Personally, I don't think it is in your best interest. You could spend your time doing something else. But I keep on seeing this logic by which rate cuts or yield collapsing should be kind of bullish for the markets. And I don't totally agree with that. And I've seen it across the board. Like, this is just one server, I mean, but even, I recorded that video, it was 2 weeks ago, kind of quoting Roman, one of my mates. But I'm keep on seeing it, even in the Italian server. I mean, right? There was this guy. It was just, I guess, it was Thursday. Yeah, just on Thursday. And yeah, of course, you're not going to be able to read that, so just going to translate it for the sake of it. But basically, was what do you think about this price action on Bitcoin? Because it looks strange to me that no matter we are seeing good data and parentheses good data like bad data for the real economy, for the logic bad news are good news, because if we get bad news for the economy, that means that the Fed will start to cut rates, and that should be bullish for assets, like in this case Bitcoin. This gentleman is looking at Bitcoin only, right? So he says it looks strange to me that no matter bad news, which should be good news, right, by logic, anyway, the price of Bitcoin keeps on falling. I'm starting to think about this idea that this announcement of a cut of 25 basis point will lead to a good sell-off. What do you think? Again, just to, I don't want to beat a dead horse right here, but just to reiterate this fact, you can just look at some charts. You just dig on the internet, and you're about to see that usually when the Fed is cutting, they're cutting for a reason. Um, you might say, yeah, to ease financial conditions, right? To stimulate the economy. Why would you want to stimulate something which is on fire? If the economy is already red hot, why would you want to stimulate that? To get what? Runaway inflation? I, you know, you usually need to stimulate something which is going down, something which is a critical condition. You know, if you are healthy, would you expect to need someone stimulating your heartbeat? Like we see on TV, clear, and they just pump the electrocharge through your body to stop back your heart because you're having a heart attack basically. You don't need that if you're healthy, right? It's same with the economy. You don't need to stimulate something which is already taking care of itself. You need to stimulate something which is kind of on a downward trajectory, so to speak. So basically, every time we had uh, an inversion of the curves, that always preceded recessions. Now, of course, this is a very simplistic way of seeing it because it doesn't really tell a lot about the timing of it. More on that in just a minute. Now, these are the next three, four slides are basically the type of movements that you have or you can see in the yields. So there is the bad flattening, which is basically what we got when the Fed actually jacked up rates. You had the short end of the curve coming down, coming up, and the long end coming up, but not just as much. All right. The opposite case is the bull flattening, just in reverse compared to the previous one. Then you got the bear steepening, which is what I guess those people calling from the death of the dollar, the demise of the United States, I guess that's what they're looking at and saying this is what's going to happen. So basically, the entire curve being steepened out, with long-term rates going higher than short-term, or rising more than short-term rates. Honestly, that would be what you want to see in a recovering economy, in a healthy economy, where you should have this type of a curve steepened out to the upside, right? And at the same time, you would want rates to come up overall because rates and yields, again, they represent inflation, but also growth expectations. So if you got something like it, that should be bear for the bonds in terms of the bond price, but should be bullish for the overall real economy. Problem is that most likely what we are seeing right now is the opposite scenario, the bull steepening, where the curve it's steepening out, of course, but because the short end is falling more than the long end. And this usually happens when the central bank is dropping rates. And as we just discussed, why would someone at the central bank be willing to drop rates? Because probably the economy is not good, right? So just to have a little bit of a broad understanding of what you look at when you're looking at yield curves and whatnot. Now, what you can see, something like this, the Fed versus the 10-year, 2-year spread. And again, this is just some sort of a recap of what happened every single time the curve went inverted, and the reasons why it went inverted and it uninverted after that, and what we have seen, um, you know, compare to how the curve was behaving and how the Fed, in this case, because we are looking at Fed funds, how the Fed actually reacted to it. I know the two are basically linked, right? But this is just a nice historical recap, and it shows that every single time you got these things going around, it never ends up well because these gray shaded areas, those are all recessions. So again, rate cuts, are they bullish? I don't know. Now, there are many different curves you can look at. Traditionally, everyone is looking at the twos and the tens because it's kind of the standard, maybe. But there are many of them. Probably not all of them we are going to have the same importance, or maybe they're not going to be the focus of what market participants and investors are looking at, but still they do exist. We're going to get to why it might be relevant in a minute. So again, these are the the thicker one. Those are the yields which have caught the attention of the markets in recent times. So basically, the two and the tens, Yeah, what should be say the tens and the twos, and the tens and the 3 month spread. Looks like those are what people are looking and checking the most. What's interesting to notice though is that basically, if it is true that every inversion precedes a recession, but it looks like these happen when more than 50% of the yield spreads are inverted, right? So the data are particularly clear on that. That's your 50% level. So essentially, when you got more than half of the curves we were looking at before inverted, that's where the signal starts to have a much more meaningful type of impact and probably predictive capabilities, right? So again, it was interesting to notice, and still I think might be valuable information. Why is that? And that brings me to here. Just the other day, again, it was Thursday. Why are we even looking at the yield curve? Well, beside my stupid joke right here, but I guess the point is that it is a signal, like a lot of different signals you can look at. And bear in mind, the problem with this signal is that the timing, as I was saying, it never really gives you the timing of it, right? So this is basically the amount of days, so the amount of time, which went through the uninversion and the moment in history where officials actually declared the recession. So that leaves you with a little bit of a conundrum, because you got the inversion first warning sign, then you got the uninversion, but at the same time, officials won't declare a recession on average, what? Almost 384 to 500. Let's say quick mental math, which I'm terrible at, but let's just say to 200 days, just for the sake of it, a little bit more than 200 days. All right, that's kind of, it's more than 6 months, should I say, right? So not only you get the information 6 months later, this post dated, but also the moment they give you the information, it might be another 6 months down the road. So when if you go and listen to officials, the moment they tell you we are in a recession, they are going to tell we were in a recession. Because most likely at that point we are already on our way out of it. Which is why I say markets tend to be better in giving you out price information you need in order to manage risk. All right. But nonetheless, having a little bit of a clue about how many days might uh, go through the moment where the curves actually uninvert to the moment where the market, and in this case, let's take the stock market as a proxy, really comes back to reality and has that Willy Coyote moment, it could be a little bit of a hint in that regard in how to manage risk if you are exposed to that type of risk. You know. Now, getting ahead, this is just a this is what can I answer this question right here. Right? We look at that. We look at the yields. I mean, it's not like it's not mandatory, right? You can look at whatever the fuck you want. But I would just say, given the data we are going to look at right now, if you discard yields, if you discard the bond market in general or the credit market in general, I guess you're missing out on a lot of good pieces of information, right? So you can see that throughout these bull steepener periods, these are the average returns for the twos and the tens when it comes down to the actual assets, so the price appreciation, right? Now, of course, you can already notice, not only because it's written right here, but even if you look at the numbers, right, you can notice that because of the convexity thing, the long end of the curve tends to return much higher figures compared to the short end. And I would assume if you put in the 30, the 20s, and the 30 years, they would go up even more than the 10s, right? But again, just to reiterate, why are we looking at these? Now, these, in the same period of bull steepening, these are the average returns. So, of course, gold miners, they tend to go up throughout a downturn, an economic downturn. But look at how the different sectors of the S&P in this case do perform. Now these are averages, right? No absolute type of returns, but just the average. Now if you go down instead, you can see the compounded return still just from the 2000s, so it's for the last 25 years. So again, the average might be one thing, okay, but the compounded, it's taking into account all the different type of iterations, I would say. Mm, might be wrong on that. Well, yeah, add, if you sum up all together, that should be kind of your final result. Hmm. Maybe I'm sleeping a little bit on the math, but at first glance, that's how I would interpret that. Now, here instead, you got your returns, and again on average, and your max drawdowns on these type of indices. So you got the Dow, you got the S&P, and you got the Nasdaq. Again, still throughout these bull steepening type of periods, right? And it's not cool, right? And of course, the Nasdaq is the one which is losing the most. Then you can categorize that in sectors. And as if you remember that chart, I think I still have it. Yeah, we're gonna look at this in a minute. But if you remember this chart, which by the way, for the last 5 days is saying the biggest losers were technology, energy, communications, well, basically every leading sector of a bull market, and the ones kind of defending themselves, of course, staples, healthcare, the usual suspects, even utilities, right? We went through these charts, I guess, probably 2 weeks ago when I was talking about not being convinced about the rally when it's not led by NQ or the Nasdaq. Um, so in here it's kind of the same thing. The drawdowns and the average returns are divided in sectors, same as the ones you were looking at in the chart I was using past weeks. And you know, here it's divided by type, market capitalization. And what is this is interesting, I think, because you see the average return and even the max drawdown, it's kind of the same for small cap, mid cap, well, pretty much across the board. Maybe growth, of course, growth you would categorize in that stocks and equities like the ones in the technology sector, right? Growth. Um, but uh, they tend to lose the same amount. The S&P overall, there is not a huge discrepancy compared what you would expect when you look at it from the standpoint of the upside potential. When you look at the upside potential, uh, we have been in a period where growth often overperformed, right? So you would expect um, to maintain a little bit more of his gains even in a downturn. Instead, it's not. But I guess there is a logic in it, right? It's not it's not random. And again, you got gold miners. which are going up overall if you look at the returns, but look at the potential drawdowns. Um, and this is something which might be interesting because when you start to think, oh, well, you know what, we're going to have a recession, so you know what I'm going to do? I'm going to ditch my stocks and I'm going to pile into gold. But when you get into the acute and initial phase of the recession, having a value like this into here, that is a testimony that gold tends to be particularly volatile. Because if you have a drawdown of 6%, that means that some way, somehow along the road, gold actually dropped. And usually that happens when you got a liquidity event. So when everyone is exiting stocks or they are suffering huge losses in stocks, they need to liquidate the gold, which is why gold tend to tank a little bit instead, together with the rest of the market. Then, of course, in the recession, it's prolonged, it's deep, you're going to see gold being appreciated a hell of a lot more. But always bear in mind the initial phases and the initial shock. Just because something goes up over time or throughout a specific amount of period of time or time span, it doesn't mean that it goes up in a straight line. So be ready to endure a little bit of a volatility in there, right? Which again, that's why I think charts like these might be particularly good to look at. And well, this is just, a little bit of an analysis of the returns, annualized returns, comparing stocks versus bonds throughout the economic cycle. So from the expansion to the mid cycle, late cycle, and then the recession, because it always works like that. You got the initial expansion, then you got the mid part of the cycle, late cycle, like the one I think we have been in since 2021, 22, most likely, and then you got the recession. And I know it's not particularly easy to read, but these data starts for, it considers all cycles since 1970. So good amount of data right there. And when we got in a bull steepener case, Fed funds being cut, these are the performance, of course, of bonds versus stocks. And you can see that there is a lot of downside in stocks and a huge amount of upside in bonds. That's natural. It's the flight to safety mechanism, right? And I know a lot of people are still struggling with it. Why would you think it's safe to put your money into bonds? But I mean, the government is just inflating away the currency and it's debasing the currency. If you're buying bonds, you're basically lending to the government, which is going to return you money which have been devalued. So you're going to lose your purchasing power when you do adjust for inflation. Yeah, if you want to buy and hold the treasury. But if you're just playing for the price appreciation and then you aim at unloading, so selling the treasury, you're basically treating as any other asset class you would speculate on. So that's the thing, I guess. Sometimes why there is that disconnection in between um, acknowledging the fact that the market is looking at bonds as a flight to safety and not as a return-free risk. Again, back to the point, it depends on your time horizon, right? Always bear it in mind. And that concludes even these charts I digged for around on the internet. But again, I just wanted to answer this question. Why are we looking at the yield curve? Because this is the type of risks that the yield curve inverting, uninverting, flattening, steepening can, you know, can suggest or can put on your radar. And that's why you should be cognizant of it. At least being cognizant. Now, again, we are going to look at what next week will bring. Um, I'm expecting a little bit more of the same. So bearish, keep on being bearish, or neutral to bearish. I'm just adding in neutral if you believe in a little bit of a relief rally after, let's say, the sharp drop in oil, sharp drop in stocks. If you want to allow a little bit of elasticity and saying, yeah, again, nothing goes up or down in a straight line, we might get a little bit of a relief rally. Yeah, so let's say for the week could be neutral, slightly bearish. All right, and let's see how it goes. So I guess that's really everything I got for the week. It was a lot, but I wanted to spend a little bit of time on these charts uh, of historical data about yields, inversion, uninversion, steepening, flattening, and whatnot. I know not a lot of people might monitor them or being interested in them, but I'm just hoping that after presenting the data and the potential effects they have on assets prices, you could appreciate them a little bit more. All right. And with that, getting into next week, have a nice Sunday, and as usual, be nice, and why not be the fuck cool, right? Nils out.